Hello everybody and welcome. James Halliwell here of the Lex Van Dam Training Academy. Very pleased today to be introducing the checklist process for company analysis, because Lex and I always find it amazing how many people own stocks that they have little and in some cases absolutely no understanding of whatsoever. And the amount of people who generate ideas by picking up newspapers and then buying a company based on that without actually doing any further research. So we think that that is not the way that you should be investing. But we also want to demonstrate that with a structured approach, using our checklist, which we apply in real time each and every month in our trading club, it doesn't actually need to be that difficult. You know, you don't need to be a CFA analyst, financial analyst, in order to understand the basics behind a business and generate a stock idea. So let's begin with a recap of the examples that we saw previously as a reminder of why we follow the process and what it enables us to do. In the case of Apple, +5, we'll go through each of the items in detail later in the presentation. And you can see, as we noted in an earlier video, the opportunity when you had all of the ducks in a row, when you'd done the research, you'd followed the process, you could have quite confidently bought into the sell-off, which on the chart took place in late 2012, early 2013. And when you see this is a weekly chart, so we can use perhaps the blue 50-week moving average, which would be the equivalent to the 200-day moving average on a daily chart approximately. Once the fundamentals were in place, once you then get the technical confirmation, and that's when you would look to commit to the trade if you hadn't begun kind of gradually staging in when the fundamental picture looked positive before the technicals turned. Conversely, not quite a strong score, but a strong one nonetheless. This time negative for Eastman Kodak, a company which is much fabled, much maligned. And as you can see here, generated a strong reading in early 2014, and the stock declined from around the time of the signal, just below $30, or call it around $30, all the way down to $8, before it then had a dead cat bounce. And as is the nature of dead cat bounces, it in fact doubled from 8 to 16, before then again trading back down to single digits, just below $10. So here again, whether you approach this as a short seller or not, it was a clear indication to avoid the company. So owning shares of Eastman Kodak wasn't going to do you any favors. The checklist that we use for company analysis is based on this 5-factor model, which we introduce in our $1 Million Traders courses in the stocks modules. So basically what we're looking to do here is provide a structure in the form of the checklist to analyze the management of the company's products. You've got to understand them, if they're relevant, how they're selling, the financial health of the company, so the financial statements, balance sheets, etc. Then we want to consider the stock market valuation and also the geographical exposure. Is the company international or is it domestic? So in this case, we'll be applying it to a company we were looking at a few months ago and is still on our radar now at the time of recording, Gilead in the US. So the first thing that I want to know, we'll be using Morningstar as a source for most of this data, and I think it's a very good free resource, but it's also worth spending a little bit of money. I think it's a couple of $100 for yearly access to their premium content, which is pretty good if you don't have access to a Bloomberg terminal. So the first thing that I want to know, just to introduce ourselves to this, check out the company's website and understand the sector and industry that the company operates in. So Gilead's a healthcare company, it's a biotech stock, and if you check out the website, you can find out more there. And of course, you have the concise descriptions on the screen now. Here we are with the checklist. First of 5 factors that I mentioned, company's management. What do we want to understand and score here? Well, again, taken from Morningstar, concentrate on the stuff highlighted in orange, because I understand there's a lot of information here. And I just want to share with you the process and the rationale behind and how we arrive at those scores on the checklist, rather than bombarding you with lots of information which might appear to some people on the face of things a bit overwhelming. What we want to understand when we're thinking of the company's management are: who's the CEO, who's the CFO, and who's the COO, and then any other sort of industry specific roles, such as in the case of other companies, chief medical officers, in the case of this company, chief scientific officers, and so on. So we want to understand at least the backgrounds of these 3 or 4 key people. There's some other interesting information on here, which I won't go into too much detail on, around compensation. It's quite interesting to see the trends overall, and for particular members of the team, you can see how they're performing and whether they're being remunerated accordingly. But the measure which really captures this in a quantifiable way, I like to look at, just as a general overview, is the return on equity. So the higher the return on equity, generally speaking, the more efficient the management. So the higher quality management in charge. You can see here the 5-year average ROE for Gilead is around 17.5%. That's slightly lower than the S&P 500, but it's pretty much in line. So that confirms that, for me, broad-based measures, that there's nothing ugly there. They're a capable management team, and it shows up in the ROE as well. If you wanted to go into a little further detail, this is the type of information that you can also see compiled by Morningstar's analysts. So it discusses the management in detail here and the effect that they've had, their track record with the company, etc. And they also have quite an interesting, again, it's their proprietary rating. You can have a look actually at the methodology. It's proprietary to them, but you can have a look at how it's derived. But they regard the stewardship, so the company's management, as exemplary, which is the highest rating. And there are only a handful of companies which attain or derive that rating. Most of them are standard. So that's a very strong indication that there's a quality management team in charge. So that, without question, is a positive if we're looking at Gilead for the first time. We now want to consider the company's products. So what do they sell? In the earlier description that we referred to, you can see here Gilead, as a top-line summary, it's involved in HIV treatments, liver disease treatments, cardiovascular treatments, and various other diseases. When we drill down a little bit further into some of the additional information, again provided by Morningstar, what we want to consider here, a little bit like Warren Buffett usually talks about, does the company and its products have a so-called moat, an economic moat? So is it vulnerable? Is the business vulnerable to the threat of new entrants and competition? Or does it maintain an advantage in that particular market? Is it dominant? And in this case, it absolutely is. It's considered to have a wide and stable economic moat. That's based on the company's products and the markets and consumers that they cater to, as well as considering other factors around competition, etc. So again, in terms of the products, they are relevant and they are leaders in the market. So again, that's got to be considered another positive attribute on the checklist. So far it's looking very good for Gilead. Now on to the financial health. You don't have to be a forensic analyst to pick up on the basics of what's going on here. First of all, I want to know company sales. Are the sales growing? Are the sales declining? Are the sales stable? What we can see here is that there is an uptrend in growth, in sales, and that's detected. It's picked up in the 5-year growth measure on the right-hand side. So 30% growth over the last 5 years. That's very healthy. You can also compare the most recent 12 months against the 5-year average. And given that the growth is positive, you also would expect to see that greater than or above average, as indeed it is. So the company's growing sales, that's healthy. In terms of its competitive position and how its ability to convert those sales into profits, I want to have a look at the margins. So if there's margin pressure, if there's a lot of competition, or if the company's not being as efficiently run as it was, or if it's facing greater cost pressures, then we would expect to see margins under pressure or margins fall. What do we see here? See stable margin and then rising margins, and in absolute terms, a very high, stable, healthy margin, almost 70% operating margin, which is fantastic. So if we look at the growth again, That's not under threat. It's in fact improved over the last 5 years. And as you can see, trailing 12-month basis versus a 5-year average, it's also corresponds to that. It's above that. And that, of course, it translates into earnings per share and so on. But without getting too bogged down in these, so I want to keep it as short and snappy and as engaging as balance sheet analysis and fundamental analysis possibly can be. The other key thing that we'd like to look for is the company spinning off cash. Is it generating lots of free cash flow in order to do that? So the starting point for this, for financial health, is the free cash flow. And you can see the company has, over the last 12 months, it basically has $13.5 billion sat in free cash, which can be distributed to shareholders. And that's grown. They've grown that position by over 35% in the last 5 years. So it's a highly cash generative company with an excellent free cash position. As an investor, I want to own businesses with that sort of financial health. So that's absolutely a positive on the checklist. So the management looks good, the products look good, financial health looks great, but what price are we trading at? The stock might be rich, or is it cheap? We'll keep things fairly simple again here by looking at the price to earnings ratio. So you can see that currently the company's trading at a PE multiple of 8.7, which compared to its 5-year average is less than half. It's considerably cheap compared to 5-year history. Also, if you look compared to the index to the right-hand side, you'll see that 8.7 is also very cheap compared to the market at 21 times earnings. So Gilead appears cheap, therefore the valuation appears attractive on a PE basis. You might also wish to look at the price to forward earnings measure, which is my and Lex's preferred measure. However, as we're going off Morningstar's data, it relies on their analysts' estimates, and we typically would prefer to look at Bloomberg's earnings estimates than the ones available on Morningstar for a more accurate representation of that. And if you do so, you see that, in fact, on a forward PE basis, Gilead is even cheaper than compared to its history than the current 11 versus 11. Pretty much, it shows it as in line here. It's way cheaper according to other estimate data. So that's why we'll use the actual reported stuff in the case of Morningstar here, rather than focusing primarily on the forward measure. But that's what you need to know. It is indeed cheap on that basis. We mentioned cash flow, the amount of free cash that the company is generating a moment ago. So what price are we, or what multiple are we paying for each dollar of cash which is generated? Well, currently we're paying 7.5 times, which again, compared to the 5-year average, is very cheap. Compared to the market, it's also very cheap. So again, it looks as though there's value here. The inverse of the PE ratio, which we looked at, the earnings yield, this gives you a crude approximation of what one might expect to earn buying at current valuations per year, according to the earnings which are being generated if they were to be sustained. So it's the inverse of the PE. So because the PE looks very cheap, this should look very high and attractive, and therefore the earnings yield is currently 11.5%, which is considerably more than the 5-year average at 8%. So again, that looks very attractive. Finally on here, again, there's many ways to skin a cat, as I say, but finally, another valuation measure often preferred by the private equity world, who are involved in takeovers, etc. You can see EV to EBITDA as a ratio. Again, it's a bit like the PE or price to cash. You see that it's currently the total company is trading at 6 times EBITDA compared to 12 historically. So it looks to be about 50% undervalued according to the last 5 years. So from a valuation perspective, again, things appear very cheap. And this is a difference following the process between finding something with a low PE that looks cheap, yet there are many reasons why it's cheap. Companies' products might be no longer in favor. It might be under intense competition or threat from new entrants, might be disrupted by new technology particularly, or the company's management might be in turmoil, and that would be a negative on the checklist. To go through and see the fundamentals, the management, the products, the financial health, etc., all pointing positive, and then see valuation attractive, it really gets my attention. And finally, it's important to consider the geographical exposure of the company as well. Now, this is just a quick screen that I took from Gilead's investor relations section of the website, and it doesn't provide a great deal of information, but it just confirms that if you haven't heard of them before, they have operations all around the world, various regions, various countries, and they have, according to investor relations prospectus, a keen strategy in emerging markets as well. So they are truly global, and therefore you want to consider perhaps currency effects, currency factors, whether or not the company has hedged the revenues, if they have exposures concentrated to a particular market over the other. But also it helps you appreciate that it isn't just a domestic US company, it's very much global. So yeah, there'll be various things that you're better informed about through completing this step of the process. So now you can see how easy was that. We've gone management +1, products +1, financial health also positive, valuation looks attractive, geographical exposure, it's an international company, it's expanding into new markets, it's not concentrated in any one particular market, looking good. Overall, we have a +5. So it's a little bit like the Apple example we had at the beginning, where we saw a very strong score. So let's see what the chart's looking like. Have we seen a rally? Well, when the analysis was put together and provided to our club members, it came on our radar just before April of 2017. So around March, April, we began looking at it. You can see that highlighted here. So that's when our checklist was fully aligned with a +5. However, the timing of the trade, you could have begun to gradually stage in if you're a longer term value investor, or you could have waited for technical confirmation if you were to trade this a little more tactically, as I did, and as some of our members did also. It was trading below the 200-day moving average in green until it broke above in late June 2017. And it was being held or sold back at the 50-day moving average for some time until it had this breakout. So there are various other levels on here as well, which I won't go into too much detail now. Basically Fibonacci levels, which I quite like to monitor. And basically what I was waiting for the stock to do was to confirm its turnaround, or to find strength by closing above and holding this Fibonacci level, so just above $70, which is quite around psychological level as well. So when we saw the break above, we also saw a gap fill take place here, which suggested at the time, as I communicated to our club members, that we might see something of a consolidation or pullback back towards the $70 level around this Fibonacci support. So once we got, having pulled back where I entered, once we got confirmation there by closing above the 200-day moving average, the trade was very much on, and the target that I set at the time, the initial target, was around $82, the next Fibonacci level. We did come back a little towards the 50-day moving average. Before then, this huge move accelerated very quickly, and then lo and behold, we've consolidated around the target that we'd set, and we're now back at the 50-day moving average. So even if you're someone who likes to trade charts and doesn't like to necessarily spend the time reading through company financial statements, company reports, etc., this goes to show what drives the investment decisions of the real money, who are the guys who really move the market. And in the case of a stock like Gilead, it takes a lot to move the market. But when people line up and when it moves, that's where you can make some real money, as we did in the case of Gilead here. So that concludes our video today on company analysis, applying the checklist process, and how we look at companies using a hedge funds approach as opposed to buying something on a rumor or on a tip alone. So I think it's really important that you understand the companies that are in your portfolio and the businesses behind the stocks that you're investing in. And this process will undoubtedly help you. And we'll be coming up with new ideas in the club to be scrutinized using the checklist process. And we hope to share many of these with you going forward. So thanks for joining me. Any questions, let me know, and I'll see you again soon.